You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
This is the Options Industry Council's Wide World of Options. Before we start today's show, listeners should know that options involve risk and are not suitable for all investors. Individuals should not enter into an options transaction until they have read and understood the disclosure document, characteristics and risks of standardized options, available by visiting the OCC.com or by contacting your broker, any exchange on which options are traded, or the Options Clearing Corporation at 125 South Franklin Street, number 1200, Chicago, Illinois, 60606. The Options Industry Council is an industry resource provided by the Options Clearing Corporation, collectively OCC. Any strategies discussed are strictly for illustrative and educational purposes only and are not to be construed as an endorsement or solicitation to buy or sell securities. Commissions, fees, margins, interest, and taxes have not been included in any of the examples used in this show. These costs impact the outcome of all stock and options transactions. Consult your tax advisor about any potential consequences. OIC was created in 1992 to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options, and the Wide World of Options radio show is one of several resources investors can utilize to learn more about options. Other resources OIC offers include webinars, articles, and self-guided options-related coursework. For more information, check out www.optionseducation.org. Now, here's your host, Mark Benzaquen.
Hello, everyone, and welcome to another episode of OIC's Wide World of Options. My name is Mark Benzaquen, and joining me once again in the studio today is my colleague, Ken Keating, a 25-year options veteran with roles ranging from market maker to risk and portfolio manager, among others, and also a fellow options instructor here at OIC. Ken, welcome back.
Thank you, Mark. It's a pleasure to be here today.
So, Ken, I found myself thinking back when we last had you in the studio during our Summer of Spreads presentations that we were doing, and the topic that you had shared with us was vertical debit and credit spreads. And if you remember in that podcast, we discussed buying one option and selling another, either for protection should the market make adverse moves or simply as a means to minimize upfront costs. Of course, there's much more to verticals below the surface, all of which you addressed in our last session. But one of the key pieces is that you're buying or selling options on a 1-to-1 ratio. So you're buying one call and selling another, you're selling one put, buying another, et cetera. The reason I bring this up is because you're going to be taking spreads to the next level with your November OIC webinar event, and you're going to be discussing something other than those 1-to-1 ratios with what we call front spreads and back spreads. So with that in mind, I was hoping you could give us a preview today of what you're going to be talking about during your next presentation when you talk about ratio spreads. How does that sound?
That sounds great.
Okay, good. Thank you. So let's go ahead and start with what may or may not be a simple question, I guess. What is a ratio spread and why might investors use them?
Well, simply put, a ratio spread is when you either buy more contracts than you sell or you sell more contracts than you buy. So when I was talking about debit and credit spreads previously, those are always done one-to-one. You buy one call, you sell another higher strike call against it. That would be a bull call spread. If you were going to establish a bear put spread, you'd buy one put and sell a lower strike put against it. And you would do that obviously for a debit, and that's the most you can lose. And when you sell a spread, the most you can make is the credit you received, and the most you can lose is the difference between strike less that credit. Now, when you're talking about a ratio spread, now we're talking about either, say, on a simple level, buying two options and selling one against it. Okay, so that's a 2-to-1 ratio, or the opposite, where you buy one option and sell two against it, and that is also a ratio spread. So when you're either buying more options than you're selling or selling more options than you're buying, that is what is considered a ratio spread. Now, anytime you buy a ratio spread, your risk and reward is pretty straightforward. Your risk is the net debit that you paid for that spread. And in theory, with a call spread, a ratio call spread, your reward is unlimited to the upside, and to the downside, obviously, you could, lose whatever debit that you paid for that spread. In the case of a ratio debit put spread, you have participation all the way down to zero, and the most you can lose is obviously the debit that you paid for that spread if the stock rallied. On the flip side, for a ratio, if you sell a ratio spread, in other words, you're buying a call, maybe selling two against it, now you've taken, you no longer have defined risk. You have unlimited risk to the upside because you're short an extra call. And on the flip side, if you did the same thing with a put spread, you would have not unlimited risk, but you would have risk down to zero from that extra put. So once again, it gets riskier when you are selling ratio spreads as opposed to buying them.
Okay, so traditionally, I guess we can look at it as the same fairly risk and reward profiles as a normal vertical. You're buying a ratio spread. If you're buying more options than you're selling and it's costing you more money, then that cost, that premium that you pay, just like with the vertical debit spread, that's going to be your maximum risk. And then if you're selling more options than you're buying, you're collecting a credit. That credit that you collect, that's going to be your maximum reward. So they kind of work in the same vein, I guess, if you will, versus verticals in that sense. Why do people want to buy more than they sell or sell more than they buy? What might investors be looking to accomplish when trading a ratio spread?
Well, let's just say maybe you're really bullish on a stock. You think it's going to make a big move to the upside, but you don't really want to pay a lot for that spread. So maybe you would, let's say stock is trading for 50, and you might consider selling the 50 level call, selling one of those, and maybe buying two of the 55 level calls against it. And depending on where the implied volatility is and the time to expiration, it's very possible that you could do that spread for possibly even money, maybe even a credit, depending on where implied volatility is. So you get the upside participation potential without having to outlay as much capital. You might be doing that for a net debit, once again, dependent upon implied volatility and duration. But oftentimes, depending on how you structure it, you can oftentimes do it for even money or even a credit. So this is a way to take an opinion, whether bullish or bearish, and reduce your capital outlay at the same time.
Okay, thank you. Let me ask you.
Sorry.
Go ahead. You had something else to add?
I was just going to say on a side note, I know a lot of people viewed your last presentations on straddles and strangles. Technically, straddles and strangles, even though they're not necessarily considered ratio spreads, they are, when you're buying a straddle, you're buying more contracts than you're selling. And if you sell a straddle, you're selling more contracts than you're buying. So both of those positions, as well as the long strangle and the short strangle, those are technically front spreads and back spreads, whether you're buying or selling them. So even though I won't be talking about straddles and strangles, technically a straddle and a strangle is technically, in a way, a form of a ratio spread because you're either net long or net short for contracts.
Oh, interesting. I didn't realize that they could be viewed that way. So that's an interesting aspect. Thank you very much. Let me ask you, one of the interesting things I think about ratio spreads, when it comes to options, the idea is to capitalize on a directional move using options. There is a ratio spread that I know that you're going to be talking about called the stock repair, where we're not really looking to capitalize on a market movement per se using options. What we're really looking to do is to basically repair that losing stock position, and doing so using options, which I think is kind of an interesting spin. So if you can, why don't you take us through the stock repair strategy and tell us how it might be structured and what the ideal outcome or what the intent of the investor is when trading a stock repair strategy.
So essentially, the stock repair strategy involves calls where you're using calls on a ratio spread to technically get back to even faster on a losing position. So let's just say you bought 100 shares of stock at 100, and now shares are trading 80. Okay, well, you could go out, you could do one of three things. You could either sell your shares at 80, take a $20 loss, or you could buy another 100 shares at 80, which would require an $8,000 capital investment. And now you belong twice as many shares, but now you've taken your break even from 100 down to 90. So in other words, the shares would have to rally only 10 points as opposed to 20 for you to get even. But once again, you would have a capital outlay of $8,000, plus you belong twice as many shares. Now, you could use options using a ratio spread that could technically not cost you. You could do it for even money, maybe even a credit, and allow you to get back to even. So what would this look like? So now the shares are trading 80. What you would do is you would buy, say, one of the 80 level calls and sell two of the 90 level calls against it. So that's a ratio spread. We're long one call, we're short two against it. Now, because of that, and if we can do that for even money and the shares go to 90, okay, now we are going to, technically, we're going to get back to even if the shares rally back to 90. They don't have to rally to 100, but we will get back to even without having to put out that additional capital outlay. Now, granted, that's as much as we can make on the position unless we roll it or do something to manage it. But to the upside, if all of a sudden the stock shoots to 100, okay, we forego any upside participation above 90. So you can kind of think of it like two positions. So by putting on a 1-by-2 call spread against stock, in theory, you are technically long one bull call spread. You're long the 80-90 call spread one time, and that extra call that you sold at the 90 level is sold against the stock position. So now you have a covered call position as one position and a bull call spread on top of that. Plus, ideally, if you can do that for even money, you've done it for free, not counting commissions or fees through your broker. But once again, this is a kind of a unique way to structure options around a stock position to get back to even sooner. Now, granted, this doesn't give you protection to the downside, but you still have that exposure. If stock goes from 80 down to 70, you're going to lose money on your long stock position. Your 1-by-2 call spread doesn't help you, but it doesn't cost you anything either. So,
right, and that sale of that additional call, that helps to reduce the overall cost of the strategy. Like you said, you can, possibly do it for, near even money, something like that. But the trade-off, obviously, again, as you had mentioned, is that, any upside participation above that additional short call strike, you forego that. So really the idea, to kind of summarize the excellent explanation that you had given, to summarize is that the idea isn't really to make money, but to get back to even, to recoup potentially recoup some of your losses in doing so at a potentially lower cost out of pocket than it would be by purchasing those additional shares, as you had mentioned, plus the additional risk of now being long 200 shares of stock versus just one. So I always thought that was an intriguing strategy, the stock repair, because I like the idea that unlike other strategies where, the goal for the investor is to, generate premium income or leverage, to derive profits from that, you're not really looking for profits. What you're looking to do is the title of the strategy. You're looking to repair your stock position and trying to get back to even money sooner than you could potentially do than by just, holding out hope that the share prices rally. So I think it's a very intriguing strategy, something that investors might want to explore, particularly those that have heavy stock positions in their portfolio. Let's go ahead and shift gears, for example, or the stock repair. So we're buying one and selling two. So that would be a front spread. Let's go the other side and look at back spreads where we're buying more options than we're selling. Tell us about back spreads and how those work, please.
Well, simply put, a ratio back spread is when you are buying more options than you're selling. So in the case of calls, maybe we would sell an at-the-money call and buy two out-of-the-money calls against it. And ideally, maybe we can do that for even money or even a credit. Now, when we're putting this on, we're doing so with the intention that we think that the stock is going to make a large bullish move to the upside, and we are looking to participate in a large bullish move, but we're not necessarily looking to outlay as a lot of money to put that position on. Because obviously, if we are bullish and we decide to maybe stocks trading 50 and we're really bullish, so if we were going to put on a debit spread, maybe we buy the 50 level calls and sell the 55s against it. Okay, well, if the stock makes a huge move to the upside, the most we can make is $5, the difference in strike less any debit that we pay. If we do the 1x2, if we sell the 50 calls and buy the 55s against them twice, now technically it's two positions, but we're also long an additional call. So we would ideally like to see that stock make a big move to the upside because in theory, if the stock makes a big move, let's say the stock goes right to our long strike. That's the worst case scenario because now the spread that we sold would be worth its maximum value. We would be looking at a $5 loss if we put the spread on for even. But if the stock makes a big move, say to 70, now that extra long call that we have at the 55 line gives us that upside participation and allows us to profit. In fact, we have unlimited profit potential to the upside should the shares make a huge move with little to no cost. So, once again, there's always risks with options when you're buying and selling options. Anytime you're buying more options than you're selling, obviously the risk is what you paid for that spread, the debit. But in this case, if we did it for even, yes, there's still risk in the spread because technically if the stock went right to our long strikes and finished there at expiration, in theory, we could lose the difference in strike. So there is defined risk. There's not no risk. There is limited defined risk. But at the same time, there's a give and take. You can't necessarily get that unlimited participation for even money without taking a little risk. So once again, it really fits somebody who's looking for a huge move either up or down and not necessarily willing to forego a debit to put that position on.
Okay, excellent. But and correct me if I'm wrong, the idea is that with a 2-by-1 ratio call spread, let's say the back spread, you're really looking at that isolated call, right? That extra call gives you all of that upside participation. The bear call spread that you're selling against that extra call kind of pays for, that extra call. It pays for that upside potential, and kind of in kind of the same way as with the stock repair, that extra short call that gives us that obligation. So am I wrong in thinking that you can kind of look at that extra option as being possibly or potentially more relevant to the strategy than the internal or the spread itself, meaning the bear call spread or the bull call spread? Does that make sense? What I'm trying to get at?
Yeah, I mean, once again, when you put on these ratio spreads and you're long more contracts than you're short, obviously you're looking for a big move, and where you get that participation is to the extra long call position.
Right.
Let's just say stock repair position. If we just put on a 1x2 call spread, we bought the at the money call and sold 2 out of the money calls. If we didn't have a stock position on, okay, that stock, if it makes a huge move to the upside, now we're short that extra out of the money call, and we have unlimited risk above our break-even point, which I'll get into. The break-evens get a little more complicated. They're not that complicated, but they're a little different. It's not necessarily at your long or short strike, but I'll get into that a little more in the presentation. But one thing to keep in mind that when you pair that ratio call spread with stock, now your risk is no longer unlimited the upside, because you're doing it against a long stock position. Once again, it's kind of like it's combining a bull call spread with a covered call position in the end. So your upside is, your downside is still in the long stock position, just like it would be in a covered call position. But once again, in a covered call, you've capped your risk, your participation to the upside, but you still have your downside risk. Same thing with the 1x2 call spread, the stock repair strategy. You're doing so knowing that going into it that you're capping your upside at a certain level at that short strike, but at the same time you still have the downside participation or the downside risk on being long the original shares of stock.
Right, and I like that way you have looking at it by isolating the two positions, the spread position, the 1x1 spread position, and then that separate extra option, whether it be long or short. I like your idea that by isolating those two positions, you can have a better idea as to how the strategy might perform or what the intent of the strategy is. So excellent. Thank you for that way of looking at it. I think it puts things in a little bit easier perspective for our listeners. Let me ask you this, because we are trading, buying more than we're selling or selling more than we're buying, how does implied volatility impact the position? And the Greeks, for example, time decay, and then just implied volatility in general, does it impact it more or less because we have a different number of options?
Absolutely. So, and once again, it obviously depends on strike selection, but in general, anytime you're long more contracts than you're short, once again, anybody puts on an options position, whether it's a single option or a complex spread, you're going to have a Greek position. You're going to have a delta position, a gamma, a theta, a vega, and a rho position by default. Options have Greeks. And anytime you're long more contracts than you're short, technically you are going to be long gamma, you're going to be long vega because you're long more contracts than you're short. And because you're long more contracts than you're short, in theory, in most cases, you're going to be having a negative theta. In other words, theta or time decay is going to be working against you in a long ratio spread scenario, at least in most of them. I'll get into this more when I talk about the spreads in more detail during my presentation. But on the flip side, if you sell a ratio spread, you sell more contracts than you buy. Now it's just the opposite. Now you're going to be technically short gamma, short vega, and theta is going to be positive. In other words, theta, you want time decay working, is going to be working for you rather than against you. So if you're long a ratio spread and the implied volatility goes higher, that actually works to your benefit because you're net long Vega. But if the stock just sits there and does nothing, or if implied volatility goes lower, that's going to hurt you a little bit. Plus, the time decay is going to hurt you. So, there's this constant, between buyers and sellers. There's, they have different implied volatility, and theta and gamma has a different effect depending on whether you're long a spread or short the spread. And once again, if you're short a ratio spread, the implied volatility you would like to see go down because you're short more contracts than you're long and you're short Vega. And if implied volatility skyrocketed, that would actually hurt you. So once again, there's all kinds of moving parts when it comes to options, and that Greek exposure is just one aspect of the spread itself.
Right. So speaking of those moving parts, let me ask you this, because this is a great transition into my next question. When it comes to position management, I like to use an example comparing a motorcycle to a bicycle. And the idea that with a motorcycle, it's a more complex machine, there's more moving parts, and if something goes wrong with the motorcycle, it's going to be harder to diagnose than if something were wrong with a bicycle. If your bicycle isn't working, it either has a flat tire or the chain is off or broken, something like that, whereas a motorcycle, it could be any number of things. What I'm getting at is that with a ratio spread, because it's got more moving parts, as you had mentioned, more parts to the machine, is position management, is it more difficult to manage a ratio spread than, say, a normal, bull or bear call spread? What do you think about that? How does position management look like with these complex trades?
Well, obviously, because a ratio spread is going to have different Greeks, you do have Greek risk there. There is, and there is going to require some management there. But, once again, we're going to be looking at ratio spreads from a simplistic standpoint, buying one, selling two, or selling two, buying one, just to give you an idea. But, a ratio spread could be, buying 150 and selling 25 or something, it could be any ratio. And depending on how big or crazy your options position gets, I know personally as a market maker, when I was trading on the floor, I would have massive positions where I'd be long and short, strikes at different durations and have multiple positions within positions. And I had a lot of Greek exposure. I was either net long a lot of Vega or short a lot of Vega, and managing that position can get a little more tricky. So the bigger your position gets, depending on what you have on, that can be a little more difficult to manage. But just from a 1x2 or 2x1 standpoint, it's a little more involved than managing just a regular debit spread or credit spread, but it's not daunting. But once again, to your motorcycle and bike analogy, the bigger and more complex your position gets, it starts to kind of look a lot more like a motorcycle, where if things go wrong, you have to kind of dial in and see where you're making or losing money and how to remedy and how to maybe manage that position or roll it or just close it down. So that's a great analogy. I love it.
Great information, Ken. Thanks so much. And certainly feel free to use the bicycle analogy if you like. I've got no problem with that. We are very much looking forward to your November events, as I know that you're going to be not only talking about what you and I discussed today, but you're certainly going to be taking a deeper dive with examples and illustrations. So definitely, listeners, I want to encourage you to register for Ken's November webinars via the events section of our OIC website, optionseducation.org. But before I let you go, Ken, I want to take a couple minutes and give our listeners another glimpse into who you are and what makes you tick, as we've been doing with the rest of our colleagues in this podcast program. So For example, I know that you are an avid practitioner of Brazilian Jiu-Jitsu. So obviously the first question that comes to mind is, does that mean that you have to register your hands as lethal weapons?
No, I've been doing Brazilian Jiu-Jitsu for probably 17 years now, off and on, a lot more consistently recently. It is I think it's probably one of the most amazing martial arts. All martial arts are amazing, and I've been doing them my whole life, but I've really concentrated on this. I actually got into it because my son started when he was 3 years old, and he took a little break, and he started back up when he was 7. And I told him if he decided to go back, I would go back with him. So I've been doing it ever since. Yeah, I've been doing it ever since. I have a love-hate relationship with it because, as much as I get a lot of benefits from it, it bangs me up a lot. And, my wife hates the fact that I do it, but it is what it is. And, I actually think it's something that everybody should do, just because it teaches you so many important life lessons. It teaches how to deal with problems and adversity, and it just gives you a really good, nice mental escape from everything else that's going on in your life. But I can't say enough about martial arts in general. But Brazilian Jiu-Jitsu, I've been doing it for over the last 17 years, and probably do it as long as I can physically. We'll see.
Yeah, that's excellent. Not only a good mental workout, but a great physical one as well, I'm sure. So remind me not to mess with you like ever. But aside from that, Ken, really, thanks for joining me in the studio today. And to all of our listeners and supporters out there, again, thanks for sharing your time with us. As always, please feel free to send us your questions via email at options@theocc.com or live chat with us on our website. And thanks again to all those listening. We'll be talking with you again very soon. Take care, everyone.
You've been listening to the Options Industry Council's Wide World of Options. If you have questions about anything you've heard on today's show, email options@theocc.com or visit www.optionseducation.org and chat with OIC's Investor Education team. Interested in connecting with OIC on social media? Subscribe to the OIC YouTube channel, like them on Facebook, follow them on Twitter at options.edu, and follow their page on LinkedIn. Thanks for listening, and be sure to tune in to the next episode of Wide World of Options.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.